Welcome to another episode of Equity Mates. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you going?
I'm very good, Bryce. Great to be back for this Tuesday episode, the second of 4 parts of this long-form interview.
Yep.
Great episode yesterday. We really went deep on investing process.
Yes.
Today we're going into an investing strategy focused on dividends.
Yes.
Yep.
So it is our pleasure to welcome back to Equity Mates David Keir from Dundas Global Investors. David, welcome.
Yes, good morning from Scotland and good afternoon to you all far away in Australia.
So David, yesterday we had a great conversation around your investing process and taking a bit of a different approach away from the screen and hunting in packs and working together and looking at different industries. So we found that really fascinating. And today we're going to be looking at your approach to investing in companies with sustainable dividends. So let's start at the top. Can you explain to us, firstly, this is your specialty. What are some of the hallmarks of sustainable dividend companies, and why is it something that you look for?
Yeah, absolutely. Let's just take that from the top. So yeah, the key point for us is over the long term, and I'll use that widely. Over the long term, there's many studies out there that show that dividend growth is the largest component of long-term equity returns. So dividend growth is a vital thing. So we try and keep it simple, and we've built a strategy that's based along finding companies that can sustainably grow their dividends over the long term. So that's a starting point. So where do we find these companies? That is the key question. And what is it that we're looking for? What is the secret sauce of these companies that we're looking for? So we find it businesses that have the ability to sell more units profitably year after year. So that's absolutely key. We don't want businesses that are in decline. We want businesses that can actually grow and sustainably grow, because the best way of getting dividend growth is by having companies that can grow their revenue, grow their profits, and then grow their dividends. So what is it we're looking for? So for us, the secret of sustainable dividend growth companies is companies that are doing this internal reinvestment. So investing today to ensure growth tomorrow. So let's just think about that for a second. So what do I mean by investing today to ensure growth tomorrow? So it's all about this internal compounding. So for us, we're spending a lot of time looking at companies' M&A strategy, so acquisitions, and that's really about investing today. We also look at CapEx, so capital expenditure. So that's putting more capacity in, and that's investing for tomorrow. But the key thing, and I'll give you some numbers on this in a second, the key thing we look at is companies' R&D. So it's investing in R&D. So these innovative new products they're designing that are going to drive the long-term growth of the company. And just to provide some context, we are a dividend growth house. And that's very different from a dividend yield house. So dividend yield house is all about getting income from companies today. We're actually much less interested in getting income from our companies today. We would rather companies are reinvesting these profits to ensure they can grow tomorrow, provide dividend growth for us tomorrow. So we're the dividend growth investors, not dividend yield investors. And that's a real key distinction. It's very hard for people to get their mindset around. So we want people to reinvest profits today to ensure growth tomorrow. So just look at our portfolio just quickly. So we break our portfolio down, and if you compare our portfolio to the All Companies World Index, and just think about CapEx for a second. So if you look at it as a percentage of sales, our companies invest 7% of their sales in CapEx per annum, and that compares against the global index of about 6%. So not a massive difference, frankly. The illuminating one, so that's obviously talking about investing in tomorrow. But investing in the day after tomorrow, the R&D, this is where the real distinction is. Our companies, they invest 7% of sales in R&D per annum, and that's against an index of only 2%. So massive differential. So our companies are reinvesting 14% of their sales in CapEx and R&D per annum, and that's against the index of 8. So that's the difference. For us, that is the key. Companies need to reinvest today's profits to grow tomorrow.
It's absolutely fascinating, and I think the point around the difference between dividend yield and dividend growth is really important, because a lot of early investors will look at dividend yield on Google Finance or Yahoo Finance, fall into the trap of the share price has fallen and the dividend yield is obviously a historic number, and they'll invest in that and get burnt. So I think the clarification there around how you approach being a dividend investor and focusing on the growth of dividends is really important. I want to pick up on what you said there around R&D, because I don't think that's something we've spoken about a lot on the show. And I imagine there's a lot of work that needs to go into actually assessing that number, because you know, a lot of companies have spent a lot of money on R&D for not a lot of results. So how do you really separate the wheat from the chaff here? How do you really find companies that are successful and good at investing in R&D?
Yeah, well, I mean, it's a great question, because what you tend to find, so I know on yesterday's show we talked a lot about doing the work yourself, is that many companies don't give you an R&D number, which you might find surprising, but when you go through the report and accounts, not all companies will disclose, excuse me, how much money they spend on sales for R&D. So we will look at that, and what's really interesting is that this comes back to what we talked about yesterday in terms of looking at companies not in isolation, but part of an industry sift. So we look at it in the round. So what we tend to do when we'll do an industry sift, we will know what the industry metrics are for R&D, for CapEx, and then we'll compare it, and we'll look at that on an absolute and relative basis. How much is this company actually investing? And what we tend to do is, if we're surprised at the number, we'll speak to the company about it and we'll learn more about it. So we'll reach out to companies and say, okay, we've been quite surprised that you're not spending as much on R&D as your peers. Why is that? Actually, your sales growth and margins are very good, which would imply that the R&D bringing new products, because when new products come through, they'll boost your sales. New products tend to be higher price, so perhaps higher margin. So you'll see the hallmarks of success. So we'll explore that with the companies and industry sources to understand what's going on there. But the key is that we don't look at it in isolation. We're looking at it as part of these industry sifts, which provide the context for us to really get under the skin there.
You know, we've heard Buffett come out and talk about the importance of return on invested capital, and I think it's Joel Greenblatt in his book, The Little Book Beats the Market or whatever, has a bit of a formula that looks at return on invested capital as well. Do you have like a set sort of metric that it sort of must pass for it to be considered as a company in your portfolio? Does it change industry to industry? I mean, the Equity Mates community love to know the numbers, so it'd be interesting to hear.
Yeah, so that's we try and keep things very, very simple. So we're trying to buy businesses that can sustainably grow their dividends at least 10% per annum. That's what we're really trying to identify. And what we're trying to do when we do our analysis of companies, it all comes down to all our work, the reading report and accounts, the industry sources, is all about trying to work out what the long-term growth rate of that company is. So we do use a DuPont formula, return on equity formula, and we look at retention rates. But let's just keep things simple. What we're trying to do really is work out what can this company sustainably grow at over the long term, and ultimately what should we expect that for dividends. So we want our companies to grow at least 10% per annum, because that will mean they can grow their dividends 10% per annum. So it is slightly more complex than that, but at a very simplistic level, we're spending all this time to work out, looking at the past and understanding, is the past prologue, can this company grow at the rates it's grown historically, and hopefully that'll be more than 10%, and that will ultimately lead to this 10% dividend growth that we seek and cherish.
David, Bryce and I are here in Australia, which is potentially the land of the dividends. We're one of, I think, 3 countries that have fully franked dividends, and Australian companies love paying dividends as a result. But for a lot of the world, buybacks are preferred over dividends because of the tax, the avoidance of double taxation, especially in the US. Over the last few years, we've really seen a lot of buybacks coming through the market. How do you approach that way of returning capital to shareholders rather than dividends? Is that something you look at, or is it purely dividends that you want to see?
No, it's absolutely vital. So we talk about this. So for us, the dividend policy is absolutely vital, and it's illuminating, and we call it the ultimate truth. So it's where the board links the past performance of the business with the future, how they see the future prospects. So it really is signaling to investors their level of confidence in the business. And for the board, it's all about, we talk about having a seat in the boardroom table. When we look at these companies, we're always putting ourselves in the board's position. And for us, it's all about making sure you're investing enough to ensure the growth of the future of the business. And that's what the board are doing. They've got to decide how much of today's profits we're going to give to investors and how much we're going to reinvest. And as talked about, I think it was yesterday, where we referenced this, that we are the dividend growth investors who would rather see companies invest today to ensure tomorrow's growth, as opposed to having a higher payout today to reward investors today. We think for sustainable dividend growth, you want to invest today. So we look at it that way. We want board to make that call to reinvest in the business. I guess we view share buybacks as more capital allocation decisions. So if after reinvesting sufficiently in the business, so those are the three blocks of M&A, CapEx and R&D, if we've invested enough in those, and obviously we want to see a sustainable and rising dividend as well. If there's capital left over, and if perhaps the balance sheet's inefficient, then companies should engage in M&A. There's no problem with that. However, we would make a couple of comments. Clearly, pensioners and investors should not rely on share buybacks, and clearly can't spend share buybacks. However, we would hope that investors and pensioners can rely on dividends and clearly can spend dividends as well.
Yeah, I think that's an important point. Now, David, we again are almost out of time. Luckily, we've got 2 more episodes to go after this. I just want to ask one final question. A term that you sometimes come across when you're talking about dividend investing are companies that fall under the dividend aristocrat bucket. And I believe, correct me if I'm wrong, but they're companies that have 25 years of consistently paying and growing their dividends to investors. Is your dream company a dividend aristocrat? Is there anything that this label sort of misses that perhaps you're looking for when you're looking for great dividend paying investments?
Yeah, so we are not that interested in dividend aristocrats. You might find that surprising, but let me tell you why. Because these businesses that pay their dividend for more than 25 years tend to be quite mature, and actually the growth of those dividends, because they've such long-standing businesses, the growth tends to be quite anemic. So I'll give you an example. If you look at the list of the 65 companies currently on that dividend aristocrat list in the US today, and it's names like, Coca-Cola be a good example. So that's quite a mature business. And if you actually look under the bonnet at Coca-Cola, Coca-Cola's sales and profits have fallen over the last 5 years. Yet the dividend has been nudged forward, so it's correctly classed as a dividend aristocrat. But for us, so if you look at the payout ratio, go back to the nuts and bolts, the payout ratio has increased from a 75% payout, which is pretty high, frankly, to over 90% over the last 5 years. So you'd have to question the sustainability of that dividend. So a lot of these businesses, yes, they have grown the dividends over 25 years, but a lot of them are quite mature, and the dividend growth you could expect will be anemic and well below the 10% that we seek and cherish. What we're more interested in actually is a piece of work done by Ned Davis, which is a leading independent research firm, and they broke the market up, looking at into various categories of dividend payers, non-payers, dividend growers. And what was really interesting is that the sweet spot that they identified was the 5-year growers. So businesses that have grown their dividend, paid and grown their dividend for 5 years, they were the best performing segment of their analysis. So that's our sweet spot as opposed to the dividend aristocrats. And one last thing, dividend cuts are horrendous, and we want to avoid them at all possible. And actually, from the Ned Davis work, the lowest returning segment was the dividend cutters.
There you go. Well, David, it's been fascinating again chatting to you about the approach to find sustainable dividend companies. We are excited about tomorrow, though, as we join you. You come back for Watchlist Wednesday to hear 3 stocks on your watch list. But again, thank you for your time, and we'll catch up with you tomorrow.
Okay, thanks very much indeed.
That brings us to the end of today's episode, but the party continues tomorrow with David returning, as I said, for Watchlist Wednesday. So Ren, we'll pick it up tomorrow.
Can't wait.